All right, next, let's dive straight into PQ2-4. So whenever it comes to these type of questions, it's very important you actually read the description because you have to put yourself in the shoes of this person or this business in order for you to best approach these questions. Once again, it's easier if you think about this from a logical standpoint, opposed from a standpoint where you want to memorize stuff, right? So let's dive right into it. A student starts a lawn care business for the summer of 2015. Below the financial data for the summer as well as a description of what the amounts relate to. So whenever you see a question, I want you to go in and realize what they're asking you to do as well. So that way you can start. So that way at least you have an idea of what you're looking for in the specific question. So after analyzing the above information, provide the following information: profit, retained earnings, equity, assets, and liabilities. Then what is the basic accounting equation for the business? So we know the accounting equation is assets equals liabilities plus shareholders' equity. After paying off the loan, how much cash will the business have? So we'll talk about that as well. If the business ended today, would the full amount of the equity be paid to the owner in cash? Why or why not? Let's dive right into it. The first thing we're going to do is we're going to go through each one of these accounts and figure out if it's going to be an asset, liability, equity, revenue, or expense. Remember, an asset is a future benefit. A liability is a future obligation. Equity, the two main accounts for owner's capital and retained earnings, or the business's net worth, or the wealth of the business. Revenue is income earned. Expenses is costs incurred, consumed, or used up. So equipment rental cost is going to be an expense, right? Because this is a cost of doing business. Container full of gas, this is going to be an asset because this is going to provide us with a future benefit. Cell phone cost is going to be an expense. Once again, it's the cost of doing business. It's the cost to be used up. The cash in the bank is going to be an asset. That's a future benefit. Cell phone cost for personal, that's irrelevant. That's because remember we talked about the separate entity principle. We have to keep our personal life and our business separate. So we're not going to include that anywhere in our business. So not available. Customer payments is going to be a revenue. That's income that we earned. Cash and bank personal, same situation. This is part of our personal life. We're going to ignore that. Advertising cost is going to be an expense. So money you put in to start the business, that right there is actually going to be, remember, owner's capital. So that's going to be equity. New video games purchase, that has nothing to do with our lawn care business. So once again, that's irrelevant, not available. Now the cost of the gas that we actually use. So since we actually used it up, we consume that expense. So that's going to be an expense. So remember, container full of gas, sorry about that. So container full of gas is an asset. Remember, that's a future benefit to us. Then once we actually use up the gas, that gives rise to an expense because that's cost because we consumed that gas, we used it up. So that gives rise to an expense because that gas is gone now. The money borrowed from the parents to start the business, that's going to be a liability because we're going to have to pay them back, a future obligation. So we know that the formula for a profit is going to be equal to revenues minus expenses. So we know that revenues is going to be, so to calculate profit, we know that the formula is revenues minus expenses. So we're going to look for all of the revenues. So the first revenue we're going to have is the customer payments. So that's just going to be the 1850. Then we have no more revenues, but we have a bunch of expenses. We got the 850 from the equipment rental cost. Subtract by the 30 from the cell phone cost for the business. Subtract by the advertising cost, $70. Subtract the gas cost is used, 138. So that means that profit is going to be $757. Now, next, we're going to calculate retained earnings. So we know that retained earnings is going to be the beginning balance, which is 0 because we're not given that, plus profit minus dividends. This beginning balance is a given to us, and since dividends is a given to us, we're going to assume both sides 0. So simply put, retained earnings is going to be just the profit that we calculated above. That's it. Let's put this as a dollar sign. This is a dollar sign. Okay, now we're going to talk about shareholders' equity. And remember, this is going to be contributed capital, or sorry, we could say term this as owner's capital, keep it consistent, plus retained earnings. So we know that owner's capital is money that the owner invests into the business. So that's 150 plus the 757. So that means that shareholders' equity, or just equity in this case, is going to be 150 plus 757. So now assets, we're going to calculate this by the main accounting equation, liabilities plus shareholders' equity. So we only have one liability, which we said was money borrowed from the parents, 150 plus 907. So 150 plus 907 gives us 1,057. Okay, so now liabilities, we already know this, so we're kind of working backwards now, right? Liabilities is going to be the 150. We already know that. So that means now that the basic accounting equation would simply be, so the basic accounting equation, remember, we know that it's assets equals liabilities plus shareholders equity, or in other words, 1,057 equals to 150 plus 907. The next question is, after paying off the loan, how much cash will the business have? This is kind of tricky. So total cash we have on hand right now is $1,025. Now we're going to subtract paying off the loan, which is 150, which is a liability we have, right? That's how much appearance it gave us. So the cash remaining after paying off that loan is going to be $875. So that being said, we will have $875 left after we pay off the loan. If the business ended today, would the full amount of the equity be paid out to the owner in cash? Why or why not? Essentially, yes. However, remember, we also have $32 worth of gas, right? So that gas would also go over to the owner as well. So cash will be paid out in $875, and then the gas of $32 the owner will also get. So yeah, this is the conclusion of PQ2-4.